Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
Hello and welcome to Wealth is in the Details with Peter Raskin from Raskin Planning Group. Today is part 4 of a great series that Peter has been putting together. Tax planning is a year-round process. And sometimes taxes can be a little bit dry, but Peter has brought us a tremendous amount of information. And being that there's a tremendous amount of information in the first 3, Peter, would you give us a little reminder of what those first 3 parts were in this series?
Sure, absolutely. There's a lot there. Part 1, we focused on the basics of tax planning and defined ordinary income deductions, capital gains, marginal and effective tax rates. In part 2, I discussed our philosophy around tax planning, how in essence we never want to let the tax tail wag the planning dog, and really the tax planning needs to be integrated with your overall planning, and finally, the tax laws are in constant flux and are likely to change in the future. So hold your hat. It's probably going to change.
Yeah, always.
Yeah, always does. We also described some of the basic concepts like tax deferred and tax-free vehicles and strategies. In part 3, last week, we continued to discuss concepts that really illustrate this integration of tax and financial planning. We looked at asset location strategies, which is really all about making sure the right asset is located in the most tax efficient kind of account. And finally, we talked about tax bracket planning and the strategy of timing income and deductions most effectively.
Yeah. And for all of those listening out there, for you audience members, please go back and listen to those first 3 parts. Okay, Peter has unpacked a tremendous amount of information in these 4 parts, or he will today in his 4th part as well. Go back, listen to it, and the thing is, I know you're going to have questions. So two instructions. Number 1, listen to those, glean the information that you want to hear about that is applicable to you, and then when that causes you to have questions, reach out to Peter and his team. Because tremendous amount of knowledge, tremendous amount of experience, and you're going to see that in today's podcast. So, Peter, where do we start today with part 4?
We'll talk about investment tax management. That'll be the first concept we'll talk about today.
All right.
But I do want to stress that as we talk to our clients about tax planning, we always bring in their other professional advisors, specifically their accountant. They really need to be part of the process, and we're really pretty much coordinating or bringing up concepts for us to dive a little bit deeper with the other professional on the team. That's
great. So you bring the team together then.
Yeah, that's really, really important.
Yeah, absolutely. All right, let's get started.
Yeah, so investment tax management, it sounds obvious. We want to make sure that we're managing taxes from an investment perspective, but this can have really significant benefits to all taxable investors. And I would suggest most of our clients are taxable investors. We discussed the advantages of capital gains and dividend tax rates versus ordinary income tax rates. And that basically means that capital gains and dividends are you pay a lower tax rate than ordinary income. One other advantage of investing in stocks and bonds as well is that you're able to sell these assets in a non-retirement account for a gain or a loss. And you can save clients significant money if you're taking advantage of those gains and losses in any given year. So tax efficient investing really means paying less tax now. And that's important because remember, a dollar paid in tax can't compound and grow. So you're keeping more of your financial portfolio.
Okay, that makes sense.
So just a review, basically in an investment portfolio, you're buying lots of different securities. And unfortunately, they all don't go up all the time. when you're buying stocks and bonds, sometimes stocks and bonds go down in value.
Yeah, I'd like them to keep going up. That'd be great. But
we all would, but it just doesn't happen.
Correct.
And it's kind of like, I think of it like a baseball team. Not every batter is hitting each and every game. They're not all hitting doubles and home runs. Sometimes they're hitting just singles. Sometimes they're striking out. And we never know which batter was going to be hot or cold in any game or series of games.
True.
So just like having losses in a portfolio is part of investing. In baseball, striking out is just part of the game. So when we're building a diversified portfolio of stocks, it's very similar to that baseball team. Not every stock's going to go up at the same time. And while that may not be great in baseball, when you're talking about investing, it can be advantageous. So we want to take advantage of those losses if they occur.
Got it.
So just as an example, I'm working now with a new client that has bought and sold stocks over the years. He's bought some good stocks and a lot of stocks that haven't done well. He's really reticent to sell the losers because he wants to wait until that stock recovers. He's reticent to sell the winners because he doesn't want to pay any capital gains taxes. And we discussed these advantages of selling the stocks with losses. And the primary advantage is he can use these losses to offset any gains in the current calendar year and in future years.
Yeah.
So that's significant. So he can basically get a free lunch now. He can sell the stocks that have seen gains, and he can sell stocks that have seen losses, and he won't really have to pay very much in tax.
And you said he could use it in future years as well. How many years are you allowed to use a loss?
These losses carry forward for unlimited years.
Oh, wow. Well, I didn't know it was unlimited. I thought there'd be some sort of cap on it.
Nope. And another advantage is if you don't have gains that can offset any losses, you can also use $3,000 of losses to offset ordinary income each year.
Oh, okay.
So in his case, he's got more losses than he has gains. We won't use all the losses in this year. And he'll be able to use that $3,000 to offset taxable income, which will save him over $700 in tax this year alone.
Wow.
Because he's in a 24% marginal tax bracket.
That's great. I think everybody out there could use an extra $720.
Yeah. And so most importantly, he's able to transition this portfolio that really wasn't designed for him. It really wasn't appropriate for him. And we're able to move it into a more diversified strategy without any tax consequences.
You know, that's a great point that you bring up, Peter. When people are coming to you, when new prospects or new clients come to you, I'm sure there's got to be a stage where you're kind of helping them clean up. Right. I mean, it's they've had investments and maybe they've gotten some bad investment advice, or the last advisor that they were using just didn't really take into account all their goals or what they truly wanted to accomplish. So there's got to be a pretty good sized cleanup stage.
Yeah, that becomes a problem for a lot of portfolios that we're looking at. They've owned stocks for a long time, and it's hard to move strategies into a more effective portfolio for them because of those tax issues. But we do it over time.
Yeah. Can we do a podcast on that?
Yeah, absolutely.
I'd like to do like a client cleanup podcast or something. I don't know what we'll call it, but yeah, I think that would be really interesting to see what your process is and how you help clients find those gaps in their current plans and the things that they need and things that they just don't need that are weighing them down, or just changes you can make. So I'd love to hear your process on that. So let's put that on one of the next podcasts.
Absolutely.
Perfect. All right. Where do we go from here?
Yeah, just to summarize, this active investment tax management is also a year-round process. Stocks go up and down in the beginning of the year and at the end of the year.
Yep.
So we want to take advantage of those fluctuations.
Okay, great.
Eric, the next concept I'd like to talk about are death and taxes.
Oh boy.
Oh boy is right. So there are two things we can count on when it comes to the future, and that's death and taxes. In future podcasts, we'll talk more about estate tax planning, but I want to describe one important concept called stepped up basis.
Stepped up basis?
Yeah.
Okay.
So if you own an asset prior to your death, the asset's cost basis will become the market value of the asset on the day of your death.
Say that again, please.
Sure. Well, I think, you know what? I think it's best to give you an example.
Okay, go for it.
So for example, you own an investment property that has a cost basis of $100,000 and it's valued now at $500,000. If you were to sell that property while you were alive, you'd have a capital gain of $400,000.
Correct.
But if your heirs inherit that property, they will get a step-up cost basis up to the value of the property at your death. So now their cost basis becomes $500,000.
Really?
And so if your heirs sell the property for that $500,000, there'll be zero capital gains tax.
Really? I didn't know that.
That's true for all sorts of property, stocks, bonds, real estate, commodities, artwork. That step up in basis can be really important especially when a client is getting closer to life expectancy. So think carefully about the timing of an asset sale, especially when that asset has really low cost basis, because that can make a huge difference to the heirs.
Yeah, absolutely.
So it sounds a bit morbid to talk about this kind of planning, but from a tax perspective, it can make a really big difference to the overall family estate and planning.
So simply put, if you have real estate, if you have collectible, if you have something of value like that, if you don't need to sell it, don't.
It may not be the best time to sell it. Exactly.
Got it. Okay. All right.
I think when you're talking to clients about their overall objectives, taxes are usually second and third in the line of priority.
Mm-hmm.
You got to make sure that you're meeting your living objectives first.
Of course. All right. So do we have anything else to cover in death and taxes?
No, I think we're done with that for
good.
now. We'll revisit that on future podcasts.
All right.
So the another strategy that I'd like to chat about is gifting strategies.
Oh, that's better.
Yeah, this is much more interesting. So giving assets away can actually maximize family wealth, and I think can reduce taxes.
Mm-hmm.
So not every family should be considering this, but for those clients that have different generations, they're very wealthy, they really might want to consider doing generational tax planning. So consider one concept which I call swapping tax brackets. So swapping a higher tax bracket for a lower tax bracket.
Okay.
Another example, grandpa and grandma have enough assets to meet all of their financial goals. They've got kids and grandkids, and the grandkids are young adults with low income, and they're in very low tax brackets. They're just getting started.
Yep.
So the grandparents might consider giving the grandkids income producing assets now, since they're in a much lower tax bracket than grandma and grandpa, and the family wins and the IRS loses.
Okay, so what would be an income producing asset?
A stock that's paying very high dividends, a piece of real estate that is paying good income for rents.
Okay.
So any asset that's producing actual current income.
Got it.
Another thing grandparents can do is to make contributions to Roth IRAs and help them contribute to Roth 401ks. So basically, grandma and grandpa are transferring family wealth that is taxable at a high tax bracket into a tax-free environment for their grandkids or even their kids. And those assets have the ability now to compound for 30, 40, 50 years. And that can be incredibly powerful to really enhance family wealth.
All right.
So I find grandparents, parents, and grandkids love these kinds of conversations. Another gifting strategy that we really we think is very important to talk to our clients about is charitable giving. And it's typically not always 100% tax driven, but tax benefits do help make charitable giving more attractive.
Mm-hmm.
And so a lot of our clients really want to provide significant resources to their charities of choice, and getting a tax benefit is another incentive.
All right.
So another thing that our clients can do is, instead of giving cash to charities, they might consider giving highly appreciated assets.
Okay.
Stocks that have appreciated in value significantly.
And do you just give those straight away, or do you do some sort of trust with them? How does that work?
Yeah, you could give it straight away to a charity, or you could give it via a donor advised fund, or some sort of private foundation.
Okay.
So there's different strategies, and again, that's another podcast that we'll go into more detail about. But I think giving appreciated assets directly to charity is advantageous.
Yeah.
And again, I think an example helps describe this. If you give a stock worth $100 with a cost basis of $10, you'll get a deduction of $100, and you won't have to pay any capital gains tax on the security.
Okay.
So if you want, you can then take $100 of cash that you would have given the charity and repurchase the same stock. So you could still own the same stock, but now your basis has increased from $10 to $100, and you've avoided paying capital gains tax.
Wow, that's great. No, that's a great strategy. I mean, because you're just basically swapping it, but you get to avoid all the capital gains.
Exactly.
Oh, that's fantastic.
Yeah, so I find a lot of our clients, especially toward the end of the year, are interested in tax planning. Unfortunately, this takes a little bit of time, so don't consider doing this on December 31st.
Yeah.
It probably would be too late to do that.
Yeah.
In part 3 of the series, I talked about the timing of income and deductions. And I was talking to a new client last week who is an executive at a publicly traded company. And he's decided he wants to exercise many of his vested stock options. And the stock is at an all-time high, and he's getting close to retirement. So he just wants to lock in those gains. And unfortunately, that transaction will drive him into the highest state and federal tax brackets, over 45%.
Oh, wow.
So it's really significant, but it's a good strategy. And what we talked about was having him make significant charitable contributions this year, since the deductions are more valuable to taxpayers in the highest tax brackets.
Mm-hmm.
So now's the year to make a very significant charitable contribution, as opposed to waiting 3, 4, or 5 years from now, when he'll likely be in a lower tax bracket.
Got it. Yep.
I mentioned earlier that many of our clients won't be able to itemize because their deductions don't exceed $24,000.
Mm-hmm.
Another charitable giving strategy is, especially if they're over age 70 and a half or older, they may want to consider using their traditional IRA to make charitable donations.
Okay. How would that work?
Yeah, so this is called a qualified charitable distribution. And what you do is you make a request to do a distribution directly from your IRA to a qualified charity.
Okay.
And the advantage of that is that distribution, that gift to your charity, counts as part of your required minimum distribution. And it is not taxable to the taxpayer.
Okay. So if it goes directly, then because normally the income coming out would be taxed.
Correct.
Right. And so, but doing a direct, now you said a qualified charity. How do you know what a qualified charity is?
It's got to be a 501c3 organization.
Okay. So, I mean, I'm assuming most churches are 501c3s.
Yes,
I know like American Heart Association, Cancer Society, all those different types of big charities are going to be 501c3s.
Yep.
Okay. Got it. Makes sense.
So in effect, especially if you aren't able to find enough deductions to get you over $24,000 if you're married,
Mm-hmm.
$12,000 if you're single, having the money come out of your IRA turns your non-deductible charitable contribution into a deductible donation.
Great.
So just a few charitable planning strategies that we think are important and helpful.
Yeah, absolutely. All right. What else do we have today, Peter?
Well, I think that wraps it up. I mean, this has been a 4-part series. It's been, what we tried to do is really describe how complicated and integrated the tax and how tax planning and financial planning can be. And it's why we feel it's vital to bring in that professional, to have the conversation early in the planning process and early in the year, especially.
Yeah.
In our discussions over the last 4 sessions, we've really just scratched the surface. There's just so much there, but I hope that you get a sense of what's available and how this kind of planning can be beneficial to our clients.
Well, I've learned something new in every podcast, so I appreciate that from my personal stance, and I know the audience is hearing a lot of new things as well. So thank you so much for these last 4, and I'm going to hold you to 2 of the podcasts that are going to be coming up at some point. Don't know when, but I want to hear more about your process or how you help a client clean up their current investments and coming from a different advisor or coming from a do-it-yourself mentality or just a do-it-yourself practice, how you go through the steps of cleaning that up to help shape their portfolios for the future for what their goals are. That was number 1. And then number 2, I really do want to dive into maybe some of the strategies specifically for, like you said, giving an asset or something of that nature to a charity using whether it's a trust, a donor advised fund, giving it to them directly, kind of the benefits and of each one of those things and kind of break down what those are. Because I know people have heard donor advised funds. It's been on the news and in the media a lot, just here and there, but they probably heard it in passing and just really don't have a clear understanding of what that means, what that looks like. So I'd really like to dive into that and be able to ask you some more questions about that. Is that okay?
Oh, absolutely. I'm excited to do that because I think it's great vehicles.
Okay, then let's mark that on the calendar and we'll get that as one of the next podcasts, and we'll all look forward to that. Any closing thoughts for today?
No, I think we're all set for now.
All right. Well, I think these last 4 podcasts brought up a lot of questions for folks, so I'm going to ask you to give your phone number out or the best way to contact you and just be able to bounce some questions off of you.
Sure. Don't hesitate to call at 617-728-7433 or send an email to peter.raskin@lfg.com.
For those that are driving, just replay this and write that down. But for those that are sitting with some sort of thing to write down with, can you give that number one more time?
617-728-7433. And they can always visit our website at raskinplanning.com.
Oh, perfect. All right, Peter, thank you so much for your time today. We'll talk to you soon.
Thanks so much, Eric.
You bet. And thank you all for listening to the Wealth is in the Details podcast with Peter Raskin. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Peter comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Thanks again for listening today. For everyone at Raskin Planning Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corporation, a broker, dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln affiliates and other fine companies. Raskin Planning Group is not an affiliate of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.